What are state bonds in public finance? Have you ever wondered how states fund big projects like schools, highways, or parks? One of the key tools they use is something called state bonds. So, what exactly are state bonds in public finance? Let's break it down. State bonds are long-term debt instruments that state governments issue to raise money. When a state needs funds for public projects, it sells these bonds to investors. In return, the state promises to pay back the borrowed amount with interest over a set period. This process allows states to gather the necessary capital without having to raise taxes immediately. The money raised through state bonds typically goes towards capital-intensive projects. These can include building new schools, upgrading transportation infrastructure, or improving water systems. Essentially, state bonds help finance projects that benefit the public in the long run. Now, let's look at the types of state bonds. There are two main categories. The first is general obligation bonds. These bonds are backed by the full faith and credit of the state. This means the state promises to use its taxing power to repay the debt. Because of this guarantee, general obligation bonds usually requiring voter approval before they can be issued. They are often used for projects that serve the public broadly. The second type is revenue bonds. Unlike general obligation bonds, revenue bonds are repaid from specific revenue sources generated by the projects they finance. For example, tolls collected from a highway or fees from a public utility can be used to pay back these bonds. Revenue bonds typically do not need voter approval and are not backed by the state's general taxing authority. One of the benefits of state bonds is their tax-exempt status. This means that the interest paid to bondholders is often exempt from federal and, sometimes state, income taxes. This tax advantage makes borrowing cheaper for states, allowing them to fund more projects. State laws also play a role in how these bonds are issued. There are regulations that dictate the process, including public disclosure requirements and limits on total debt. Some states have created bond authorities to manage the issuance of bonds and oversee public project financing. This can include specialized bonds, like green bonds, which are aimed at funding clean energy initiatives. Issuing bonds allows states to spread the cost of large infrastructure projects over time. This means that payments can be aligned with the period during which the public benefits from these projects. It helps states manage their budgets by avoiding large upfront costs that can strain current revenues, which are often reserved for ongoing services. In summary, state bonds are important financial tools that help state governments fund long-term public investments. They allow states to borrow money under specific legal frameworks, ensuring that projects are completed responsibly and transparently.